Okay, hi guys, Richard Jackson here again. Let me just talk about some theory with trading, how to set a framework for you to try and understand what's going on. Now, a lot of people get into trades, or you hear stories, oh, somebody's made, a big win here, or, they've just made 100 grand or $1 million here or there. But, you really need to consider as well, how many times did they lose to be able to get to that big win that they finally had. A lot of people like to talk only about the good things in their life. However, we've got to measure that against the all of the other things that have happened as well. Okay, so certainly never get upset when you hear somebody making a big win, because you don't know how many losses that they've made to get to that point. Now, trading in the financial markets is a game of probability, okay? And what that means is there's randomness, it's complete chaos. I've got two articles that I've written on the Jackson Capital website under articles here. One's called Quantifying Randomness, and the other one is Cosmos and Chaos, Trading in the Financial Markets. I 100% would really like everybody to read both of those articles. As what they will do is explain to you that that the financial markets, any financial market, any particular instrument, is a game of chaos, because there is lots of different influences, small initial conditions, and lots of topological mixing that goes along with it. So what I want you to do is read both of those articles, Cosmos and Chaos, Trading the Financial Markets, and Quantifying Randomness. Okay, so how do we trade? What is the fundamental framework of a successful trader? Now, let's just quickly go back here. Okay, it's in Module 2. Let me just double check that. Yep, Module 2, Getting Started. I'm just going to briefly go over probability, okay? If you just take a punt at the market, you've got a 1 in 2 chance that is either going to go up or down. It's up to you. However, because we are active traders, we want to be able to get a probability that's in our favor. Now, probabilities in our favor come from two different things, and you may have heard this before. Those two things are a win-loss ratio. Do we have a winning success, or success of our trading system that's in our favor, okay? Or the next one is risk reward, okay? It's very hard in the financial markets to be able to get a high win-loss ratio unless you are scalping, and that's what we do not do. We do not scalp. However, what we can do is mix a particular, or find a sweet spot for a reasonable win-loss ratio, and couple that with a risk-reward ratio that's in our favor. Okay, and what that's doing is giving us an edge. Like a casino, the edge is in the favor of the house. Okay, if you trade, the longer you trade at a casino, or longer you bet at a casino, the higher the probability that you will lose. Okay, the only way that you will win at a casino is punt big, punt once or twice, and if you get a good return, walk out the door. Okay, the longer they keep you there, the higher the probability of you losing. Okay, so what we are going to do is we want to be able to build an edge, or probability of us winning, like the house, like a casino. So we want the probability in our favor. And let me just talk to you about two examples here. Let's pretend that we have a formula for winning win-loss ratio of 65%. Every time that we win, we receive $100, and every time that we lose, we have to pay out $100. So what's that as a risk-reward? It's a 1-to-1 risk-reward ratio. So what that would mean is that if we played 100 times, we would win $6,500 and we would lose $3,500. We'd left with $3,000. So that's a nice win-loss ratio. But if we can make that even better. Let's think about something else. If we have an example of where we've won 65% of the time, however, the same win-loss ratio, however, we win every time we win $150, and every time we lose only $25. Then the odds change dramatically in our favour. So if we play 100 times, then we win 9,750, and we only lose 875, which gives us a high profit in the end. So in this case here, we can afford to have a lower win-loss ratio because we've got a high risk-reward ratio. Okay, so typically in trading, we're looking for risk-reward ratios that are more than 1:2. Okay, so the reward is 2 times bigger than the risk. Okay, so so that is essentially the theory of how an individual should trade. Now, I've spoken in some of the other webinars, etc., how to place your stop losses and profit targets in accordance to a proper win-loss ratio, and I'll leave that to you to go and find that information and watch those videos, and obviously read all of the material as well. So I'll leave it there, and hopefully I've explained myself well. If you have any questions about that, please email me. Okay, thanks guys.